Meanwhile, our next session starts. I would like to share with you a couple of things. No? First, maybe most of you, we wanted to arise some questions, but tomorrow in the seventh session, we have the opportunity to maintain a dialogue with all of you, probably. So don't worry about that. My second comment related to the previous session is that even though Maud has made an excellent summary and discussion, I remember my old times in the Spanish Banking Association, before the Banco de España, and I remember the first days on climate change. And I think that the most relevant tipping point when we are talking climate change and financial institution was supervisory expectations and stress testing climate. So these two tools related to supervision are crucial, was crucial in that time to introduce these topics in the financial system. Now, I think that we have the opportunity to do the same in nature and water-related risk. And my second comment is related to the following session, because NGFS have just published a very, very interesting paper on catastrophes worldwide, studying 31 cases around the world in the last few years, and they have estimated that the cost of these catastrophes has been close to $200 billion in the last few years. Most of them, more than 70% of the catastrophes were related to water-related risk. So the question is, who is paying these catastrophes? Who is paying this fiscal debt? Who is paying the problems related to this risk? So I think that this session is precisely ideal to answer this kind of question. But before that, let me introduce, apart from the content, I am very happy because Esther Gordo, one of the speakers, was the first person that I worked with here in the Bank of Spain many, many years ago. And I'm happy to introduce once again with Esther. And Noelia, the moderator, that will be the moderator of the session, is part of my team. And this session, this conference has been successful so far because of her. So thank you very much.
Okay, well, good evening or good afternoon, everybody. Welcome to this session 4 that I will be moderating today. And before we start, let me remind you that the session is being recorded and that pictures might be taken as well. And to start a little bit about the logistics, we're going to have a couple of rounds of questions with the speakers that we have here today, and then we will open the floor for questions from the audience and online. So let me start by setting the scene for the discussion over the next 1 hour and 50 minutes or so. We all know that water risks are being increasingly considered as a microfinancial stability challenge, but it's not so much considered as a core fiscal risk. It's more like a background risk. However, it's clear that droughts, floods, or any kind of problems with quality of water have direct impacts on the fiscal balances in revenues and also in expenditure. Think about any kind of expense of reconstruction, any kind of support for families or firms affected by this kind of extreme events, and also revenue losses, of course, if the production stops in the area affected. This, of course, can even translate to the debt dynamics of the public sector and affect also the way financial markets see the credit risk of the sovereign debt and sub-sovereign debt. The transmission channels of water risk to public finances are very important for governments, not only because they affect fiscal balances, but also because governments face a difficult choice in between investing in resilience to be more resilient to face these shocks, or complying with normally tight fiscal rules and constraints that they may have. So to talk about water risk, we have an outstanding panel of experts here on the stage that I'm very, very happy to welcome you all. We have Ramsri, who is Vice President and Senior Credit Officer in Moody's Sustainable Finance Group. Esther Gordo, who is right by my side. She was a colleague of mine 2 years ago. She's Director of Economic Analysis at Spain's Independent Fiscal Authority. Hélène Herhart, Senior Economist at the Agence Française de Développement. And we have also John Matthews, who is Director of the Alliance for Global Water Adaptation. And finally, we have Tim Segbor, Senior Advisor for Regulatory and Corporate Affairs at the Public Sector Bank, NWB. So welcome. Thank you for your sharing, for you sharing all your thoughts and insights that I'm sure that you are going to handle us. And well, let me just kick off the discussion. I would like to focus first on the credit perspective of the water risks. And it's true that water is increasingly recognized as a transmission channel of the effects of climate change, with very strong impact in economic output and fiscal balances. So Ram, from Moody's ratings perspective, I would like to know if you can provide some thoughts on where is the water stress already showing up as a material credit consideration for sovereign and sub-sovereigns, and what determines whether similar levels of water stress produce different credit outcomes. So I think that you have prepared a couple of slides. So the floor is yours. Thank you.
Sure. Well, thank you so much for the introduction, Naoli. And it's great to be here, hearing so much rich content throughout the day, and a pleasure to share how Moody's looks at these risks, especially water management risk. So just to start off with, I have 2 slides. We'll try to get them over relatively quickly. It's been a long day to everyone, and you've heard a lot of content, so I want to keep my comments very punchy, very, very short. So water management or water risk for Moody's is not a new risk that we've looked at. We have water management within our methodology. It's one of 5 environmental pillars, along with natural capital, carbon transition, waste and pollution, and physical climate risk. So it has its own pillar within our sustainable finance methodology. But the interesting story is really the scale of how water management has risen. So back in 2020, the exposed debt of water management risk was about 900 billion across all our sectors. And the number today, that's 2 trillion. And so that's doubled in about 5-6 years. And this analysis, our global analysts go away every year, look at all the sectors and rate each of the 5 environmental risk pillars. And again, water management is coming up the ladder. So as you can see here, at the top, you have the critical minerals, you have oil and gas, water and waste pollution. But also on the bottom, you can see where we have regional and local governments, coal mining, and infrastructure projects. So when we look at the issuer level, we actually have 1/3 of our rated debt sovereigns who are exposed to already water management risk. So this means water management risk is already impacting their credit metrics, the fiscal space, and so on and so forth. So I think that's a pretty big number there. But also another big number, we have 6.5 trillion worth of debt, which have moderate risk to water management risk. And what you can see here is sectors such as data centers, semiconductors, all are right now have moderate risk to water management risk. But with credit, our focus is very niche. Exposure is not always risk. So what I want to show you, again, at a very high level, is how Moody's looks at these risks. Essentially, water is a mechanism for physical climate risk impacting economic balances and fiscal spaces. So as you can see here, we look at 3, this is a very high level, obviously it's very nuanced with different sectors, but at a very high level, we look at scarcity. So we can see examples where you have the Taiwan drought impacting semiconductor industry, Zambia hydropower failing, impacting 12 hours of no electricity, and so on and so forth. And of course, the Panama Canal impacting almost 20% of flows through supply chains. So this is scarcity. And of course, we have flooding, which is a lot more acute. Of course, we've spoken about Dana flooding with Spain, which impacted a lot of lives, but also billions of dollars or euros of impact. But also, in 2022, the Pakistan flood actually caused a downgrade. So this is a real example of how water management or physical climate risk or flooding is impacting credit already. And then, of course, we have degradation quality, which will impact, again, we talked about clean water, safe water. This will impact, erodes reputational risk, but also impacts regulation risk. So, overall, to your question, water management is not something new we're looking at. It's already impacting our credit metrics. And if anything, we have a lot more debt which have moderate risk, and that could seek up to the high risk.
Well, I think that's good news that the financial markets are starting to price in the risks coming from water. So, yes, let me now focus on the impact of this water risk on emerging and developing countries. So, Hélène, your research explores how biodiversity and nature-related risk, and in that broader frame, also water risks, translate into sovereign risks, particularly in emerging and developing economies. I would like to ask you, what does the evidence actually show about how these risks affect public finances, external accounts, and the macroeconomy in general? And how is your institution building the analytical work into its country risk assessment and financing decisions?
Thank you very much for the invitation. Indeed, at AFD, the French Development Agency, we did some research and published our report recently about biodiversity, macroeconomy, and sovereign risk. And it's based on a framework and methodology that we developed in order to assess macroeconomic exposure for 158 countries to their exposure to nature-related risks. So we have measured the exposition of production, so GDP, tax revenue, exports, and employment for every country out of the 158. And what we found, some of the results are that, as you mentioned, low-income economies are the one with the highest exposure to these nature-related risk. To give you an idea of the size and the magnitude, it's over 50% of production and more than 65% of exports that are generated by economic activities that rely strongly on at least one ecosystem service provided by nature. High-income economies are less exposed, but still they are exposed at a significant level because we find that it's over 30% of production that are exposed to strongly to at least one ecosystem service. We are able to disaggregate and to look at each ecosystem service and to rank which one is the most critical one. And from what we see is that the 5 that are related to water, namely water supply, water purification, water flow regulation, are the ones that present the highest levels of criticality. And again, we see that low-income countries are most exposed to that issue than high-income economies. On average, the production of low-income countries is dependent at the level of 35% on these water ecosystem services. With such macroeconomic exposure, the interruption of alteration of ecosystem services would have impacts on the economic situation, on export earnings that generate foreign exchange to repay external debt, and as well on public finances. And that's why we integrate that now into our sovereign risk assessments. To give you an example, about an illustration for a middle-income country, Morocco or Indonesia. In these two countries, it's over around 35% of exports that are dependent on water ecosystem services, and 25% of tax revenues. So it was stressed earlier in the previous session by our colleague from Morocco that it's a water scarce country, so that's why it can have huge impact on the economy. So from that data that we build, within AFD, and mentioned it, we integrate this quantification of water-related macro-financial risk into our internal credit rating, credit risk assessment, because we are a bank as well and have to integrate that dimension within our rating for sovereigns to which we lend. And in parallel, we support Ministry of Finance and central banks in several countries in the world in order to assess nature-related risk with that tool that we developed. And discussing with Ministry of Finance is quite a powerful tool and powerful way to highlight, to call for action and call for investment. And we are able to identify quite precisely where the risk lies, which ecosystem services is more at risk, and which one is worth monitoring or investing to remediate, to build resilience.
Okay, so from the data that you just presented to us, we can really feel that economies in emerging markets are really suffering the effects of water stress. So now let's focus on one developed country, for example, Spain. Esther, from your institution vantage as an independent fiscal authority, I would like to ask you how are water-related shocks currently showing Spain's fiscal picture, and where are the contingent liabilities most underestimated, and what does that tell us about fiscal frameworks more broadly?
Thank you, Noelia. First of all, I would like to thank you, thank the organizers for the invitation to this conference, to the OECD, to the Bank of Spain. For me, it's a real privilege, as you can imagine, to be back at home and to be with you, Juan Carlos, Noelia, and of course, with the rest of panelists. As Juan Carlos was mentioning previously, if one could ask why a central bank is interested in this topic, the same question could apply to a fiscal institution with the additional thing that we don't tend to have too much resources. So in our case, the question is more significant. I would say that, of course, water-related shocks are affecting Spain already affecting Spain in a significant way, with an intensity that is changing the way that we do fiscal analysis. I will try to show you why it's so important for an economy as Spain in the next 4 or 5 minutes, and what are the works that we are doing at IREF, at my institution, my fiscal institution, to address the topic. The question why is so important is not surprising. We are living in the fastest warming continent in the world, Europe, and in the case of Spain, we have seen recently a lot of events, floods, droughts, water scarcity episodes that is affecting the functioning of the economy and of the country. These events have, as Noelia was mentioning previously, have significant implications for public accounts. You can imagine compensation to households, compensation to firms, to some sectors, agricultural, construction, and also investment in rebuilding, in reconstruction, in infrastructure. So you can imagine that public accounts are really affected by these events. So from our perspective, we think, and we tend to have the view that they are becoming really a key test, a core test for fiscal planning. So we began to thought that we need to integrate in our analysis. We cannot rely more on just only a baseline scenario for debt and deficit. We have to introduce this uncertainty and other events in our estimates. And this is the direction that the reform of the European fiscal framework has taken in recent years. As you know, we have a reform of the fiscal framework that entered into force 2 years ago. And the reform says that, according to the new provisions, member states are now expected to integrate the macro fiscal implication, not only the macro, but also the fiscal implications of climate change into the analysis of public accounts, into the analysis of public debt sustainability, and also to quantify contingent liabilities and to analyze fiscal risk. However, as was mentioned this morning by a lot of people in this room, putting these requirements into practice, in operationalizing these requirements faces a significant, I would say a significant, not significant challenges, a significant challenge, which is that data on water-related costs from the fiscal perspective is really, really scarce. We have some international data sets, such as the MDAT, that tries to address this lack of data. But in the case of Spain, we have found that it does not provide the full picture of all the risks, the fiscal risks and fiscal costs we are facing. And at the national level, of course, we have a lot of information about events that is somewhat dispersed across ministries or agencies, but we have very good information about events, but we don't have any source of information about the fiscal cost of these events. I must say that in the case in Spain, the institutional response to this type of water-related shocks takes two forms. The first is the one assumed by the Insurance Compensation Consortium. I've seen here the responsible of the consortium, that in normal situations is the key absorber. It can absorb the cost of normal events. But in case of extreme events, the resources and reserves can be exhausted. They may face some structural limits for compensating household and firms. So we have a second element, which is the discretionary action by our government. And the issue in Spain that has allowed us to identify the fiscal costs is that they need to these discretionary actions need to be approved by the Council of Ministers, and they need to be published in the references that they publish every time they meet. So that's the gap we try to address at IREF. We have undertaken a very demanding and challenging project to construct a new data set on the fiscal cost of natural disasters in Spain. To do that, we conducted a textual analysis of these references of the Council of Ministries using artificial intelligence techniques. We have identified more than 400 natural disasters in Spain in the last 20 years, and we analyzed close to 1,500 policy measures. We will publish the results in just 2 weeks, so you have to take time to read our report. And here I like to stress the main points and the main results of our analysis. The first and very interesting for this conference is that we find that water-related shocks are one of the most important categories of climate-related fiscal risks in Spain. The first one was the pandemic. The second one are water-related shocks. And over the period, the last 20 years, the cumulative fiscal cost of policy measures in response to droughts and floods was about 20 billion, here billions, not trillions, we are a small economy, was about 20 billion, close to 1%, 1.5% of GDP, including the losses assumed by the consortium. It seems a quantity in 20 years that it can be accommodated in our budgets. the most important question is that the distribution of risk is really, really highly asymmetric. Just only one event, the floods that we have experienced in Valencia 2 years ago, accounted for more than 10 billion, which is close to 1% of our GDP, and it was really, really above any previous hydrological disaster. Our data allows us also to identify what the composition of shocks. Floods represent 80% of this amount. Droughts are different. They develop over months, and the fiscal response tends to accumulate more gradually. We can identify not only compensation to households, we can identify also investment in resilience. And in the case of droughts, for example, one interesting finding is that the response seems to be shifting from investment in resilience to compensation to households. That for us is important because compensation, of course, tends to smooth the immediate damage, but it does not necessarily reduce future exposure. So, well, we are working there. We need to work more. We need to collect more data. But for me, and in our view, integrating and improving the analysis of this risk is not an option. It's something that it needs to be accommodated in the fiscal analysis we do.
Yes, I mean, listening all the figures that you have provided here, I mean, we can really feel that water risks are materially important for fiscal balances, of course. It's true that you are taking steps, maybe small ones at the European level and also at the national level, but the feeling is that physical water risks are not fully integrated in the fiscal frameworks as yet, due to problems with the metrics, information gaps, modelization, and many other things. But yes, it's like a task that we still have to face to keep on working on this. So this is really bringing us to a broader disconnect in how these risks are assessed and how they are managed. So, John, most water risk frameworks were built around environmental and operational concerns, not fiscal ones. But from your global perspective point, where is the disconnect between how water risks are assessed on the ground and how they show up or do not show up in finance ministry and treasury thinking?
Thank you for that question, and I also want to thank the organizers for the invitation to come here. It's been an amazing discussion. I feel like I've learned quite a bit already. And if you're not familiar with what AGWA stands for, it's the Alliance for Global Water Adaptation. We're a global NGO about 15 years old, co-founded with the World Bank to look at the nexus of water and climate change. So this space about our body of knowledge and how we see, especially water and climate risk at the kind of asset level versus at the level of a finance ministry or treasury. It's a big gap, but I also feel a little encouraged over the course of today so far that, at least in some elements, it's really starting to close. I'd say, as an initial comment, we know a lot more, have improved a lot more at that asset level, at the level of an individual project, and there's been a huge amount of technical expertise that's really developed there. I think that the gap is really in the second part of the question, really how we start to think in a treasury department, in a finance ministry, in a central bank about where these issues play out, what the implications are. And the gap is real, and it has been persistent. And to borrow maybe a comment that Kate made in her initial comments this morning, she was asked, what is the one thing that we could do differently? And she said, systems thinking. And I actually, I think that there are probably at least 3 systems that we should be thinking about when we think about financial systems. And the first one is the one that probably the most work has also happened on, and that's the kind of nature and climate systems. That we know a fair amount, at least in terms of direct physical impacts, about how to count that. And the big lessons, they're not really in terms of knowing on May 21st of 2043 exactly what's going to happen on the climate that day. But the big lesson that is actually maybe to pull from the previous speaker, that we actually know that we have no idea what's going to happen that day. That actually the uncertainty is one of the important lessons. Maybe to draw on Juan Carlos's opening remarks, the science actually tells us that the science can't tell us that much. And that's an important statement. It can draw some error boundaries around what might happen, but actually, like, the decision space is much larger than it had been. So the term that's been used, especially with regard to water resources and kind of emerging climate risks, is deep uncertainty, a term coined by an economist from the World Bank around 2012, Stefan Huygat, a fantastic paper if you haven't read it. But the idea of deep uncertainty is like we may be getting wetter, we may be getting drier, but it's very difficult to say, especially if we look past 10 or 20 or 30 years, exactly which one we may be heading for. So how do we prepare for both, right? And it's very expensive to prepare for both of those. And so the lesson, I would argue, from science is that we need to focus on ideas where we build on resilience, kind of relating to the previous panel. So instead of saying, like, this is the number that we can use to manage water in 2050 or 2035 or this year, we may actually need to step back a little bit and say, we need to actually invest in flexibility. We need to invest in decision-making systems that allow us to become robust in an incremental way. And that's a very different approach than most governments, most institutions have treated water. We've treated that we can look at the past 30 years or 50 years and we'll know what's going to happen in the future. And that's not a safe, it's not a sound, it's not a prudential decision at this point. The second system that I think we need to be interacting with is the governance system. And especially with regard to water, that is often not just how we adjudicate conflict or manage relationships, it's also how we bring on new sectors. For instance, Microsoft spoke earlier today. The tech sector and its relationship with water, it's a new relationship. Where we have a new series of seats at the table that we have to make room for and have to decide how we organize around them and how we allocate water for these areas relative to maybe much older parts of our economies and our societies, like agriculture. And they may be economically really important. We may see them as critically important in the future, but we also have what you might call legacy parts of the economy that we also need to include and address. An example of the kind of big think that can happen inside of governance and allocation systems is the Colorado Compact. It was for the Colorado River in the US. Unfortunately, did not include Mexico. Still doesn't really include Mexico. But it was created around 1923, and it created a whole series of water-sharing relationships for about 30% of the U.S., a huge part of our geography, and the kind of core part of the southwestern region of the U.S. At the time of the signing of the Colorado Compact, it only had around maybe 300,000 people. It has 44 million now. And it's because of the Colorado Compact. It was essentially a master plan of making water the kind of economic fuel for what development was going to happen. It made California rich. California was not a rich place before then. And that's a powerful idea because right now the Colorado Compact doesn't work anymore. And the reason it doesn't work is because it's a set of governance and allocation relationships that no longer match the climate, and they haven't matched that climate that it's in for at least 30 years. And it's proving extremely difficult to renegotiate those relationships. So the governance system is actually, it can exacerbate and impact. It goes well beyond those direct physical risks that we see in the nature and climate system. And we need to think about it, because the insights behind the Colorado Compact, that's what Ethiopia uses. That's what India uses. It's what China uses in how they think about water and their future economic development. And the third area, I would say, the third system that we need to think about is the political system. The political system is where we develop consensus and priorities. And this is also a very serious challenge. There are good things and bad things that are happening in that space. And to use maybe two examples from the US again. Florida, I would argue, is a bad example. This is a state in the US that's highly exposed to increasingly more severe extreme climate events like hurricanes. At the same time, it also is having increasingly severe water scarcity events. Puerto Rico, a little bit to the right of Florida, for instance, a few years ago had 2 Category 5 hurricanes hit it in the same year. It still has not recovered from those 2 massive storms. The legislature and the governor in Florida don't believe in climate change, and they have forbidden it from being included in policy systems. They have downgraded climate issues in terms of how they should be thinking about the state's economic development. And I would argue that's a pretty big risk, and it's going to influence the way the state, say, makes its infrastructure investments, its bond agreements, the way that they relate to Moody's in getting their credit ratings. California is a very different state. They have prioritized climate change. In fact, the governor for the state, Gavin Newsom, he actually says we don't need to just talk about reducing risk. He literally said something like, we don't need to talk about how to like shave a minute off of our showers next year and keep doing that every year. What we need to be doing instead is thinking about how to show that California is a water-abundant economy. That's how we got rich in the first half of the 20th century. And if we don't show that we are a water-abundant economy, then people will de-invest. They will leave the state, and they will deprioritize coming here. And these are scenarios that are playing out in many countries around the world right now in terms of this kind of tension and dialogue. Those are extreme examples, but I think they're important. What are the implications for to go back to the original point of your question, how should a central bank be thinking about these issues? And I'd say be very careful with climate data. There have been a lot of references to data, and I'd say that climate data in particular is very easy to misuse. And the most progressive institutions that I know in the financial space and how they approach climate data, they are very conservative with it. They focus on the error bars, not on the middle, and not on the means. And they're also interested in what's past the error bars. So all of that data is actually really important. Another a big issue is to focus on the transitions that we're headed towards. So some of those transitions are really significant and large. For instance, in many parts of the world where water accumulates during the dry season, accumulates during the wet season as snow at a high altitude and snowpack, that's going away. That we're essentially seeing, even when there's no change in annual precipitation, we're seeing a change in when water actually is present in our rivers and our lakes. It's mostly, we're losing our natural reservoirs of water resources. That's something that actually is a high confidence outcome. We can predict it. We can also compensate for it too. It will require significant investment, and we can work in that space. But it's something that the financial system should be seen as a kind of long-term, high confidence impact. I think there also are going to be really difficult choices that are coming ahead. Someone mentioned in the last panel, I think, about sea level rise, and I'll use that as an example. Sea level rise, so far, it has been very incremental, on the order of like less than a centimeter a year. But that's going to change. I'm not sure exactly when it's going to change. No climate scientist would actually tell you with any confidence. But we will see sea level rise in the order of several centimeters in a year, perhaps tens of centimeters in a year. It will accelerate very rapidly and very suddenly during periods. That is, we actually need to be thinking about the change in value of our coastal areas, right? And that's going to be a very complicated process in countries with coastlines. And the financial institutions will experience that as a massive shock. And I would say the insurance companies, the reinsurance companies, their backstop is actually the political system and the official financial system. That they will have to step in for these kinds of crises. My last point, and it's an example from Spain, it's also about how we start to think about how to leverage not just the risks, but actually the opportunity that may be around this, to go from just simply reducing risk to actually kind of an enabling a resilience approach. And I'm going to use Spain as an example there. Spain has had, as an excellent and long-standing drought insurance program. It's worked for farmers over the last several decades. At least 3 times it has actually zeroed out. It's run out of money because of the strength of the claims. And so the national government has been the source of refilling that container. And each time they've had to refill it more. I think one of the insights that's happening with a lot of state-mandated aspects of the financial system is to say we don't need to pay people just for damages so that they can keep doing the same thing. We need to pay people so that they do something else, that they need to make some kind of a transition. Maybe it's a different kind of crop, maybe it's a different season or different kind of agricultural methodology. Maybe it's also reprioritizing the agricultural sector versus another sector. And those are the kinds of changes that we can expect to be making much more regularly and consistently going forward. Thank you.
Thank you, John. At the end of the day, what you are just suggesting is that we have to have systems thinking. Water problems need to be faced or understood in a holistic way. What we need to do is link infrastructure, governance, of course, and a political system that promotes the right incentives to face these risks. So now coming to you, Tim, I would like to ask you about public investment. You know that public investment in water infrastructure is often seen as a key lever to reduce exposures to water-related shocks. It's coming back again to what John said before. It's important, the resilience investment. So from your perspective at NWB Bank, Tim, how does this investment actually shape the exposure of different stakeholders to water risks? And in particular, how does the impact differ between entities directly responsible for water management and those that are more indirectly exposed?
Okay, well, thank you first for having me, and maybe as a small introduction on the bank, so setting the scene, NWB Bank is a promotional bank in the Netherlands and is pursuing government policy and financing public sector actors, schools, hospitals, water authorities, drinking water companies, and housing associations, in a nutshell. So maybe I think during the day it has been mentioned over and over again that water is affecting all sectors, so it's also affecting the public sector. So that's not a surprise, I guess. But maybe it's interesting to make a distinction here between those who are directly responsible for the management and others. And if I look at those responsible for the management, those are the water authorities who are responsible for flooding risk, for water quality and water quantity, and drinking water companies who are, of course, responsible for providing fresh water. If I look at those institutions, how does it show up at their balance sheet? Well, it shouldn't be a surprise that due to the changes in climate, the duties become more and more challenging. So, and challenging that will, of course, result in higher costs. So that's, I think, on their balance sheet, the most prominent effect you see. If you look at the other institutions, I think, and I mentioned housing associations, well, there it shows up in the assets, so damage to assets due to pluvial flooding, or asset valuation, because they are located in areas which, well, might not be sustainable in the long term. And of course, those two are intertwined. Actions from one, so the water management authorities, well, impact the others. If there's more flood protection, of course, the asset value of the housing associations will increase. On the other hand, if the housing associations build water-efficient homes, then the management of water and the supply of fresh water will be less costly. So there's an interaction between those two. And, well, just, I think, context is important. It was mentioned before in water, but it's also in the budget, I think. So you have to look at how it is organized in the country. If I look at in the Netherlands, which is very useful in this respect, I think, worth highlighting, that water authorities have tax raising capacity. So that's a real distinction, I think, to situations where it relies on the general government budget. First of all, it is a bit out of the political arena of priorities, and second of all, it is not directly in the budget of the government. So that's one element. Another example which I would like to mention in this regard is the Delta Fund. It is anchored in legislation, and it is attached to the Delta program. It's a long-term program, which is, again, it makes money strictly for that purpose, and we are talking about long-term challenges. So I think that is very helpful. It's also helpful to consider what is the impact. And maybe lastly, and it also relates to the comments made earlier on resilience, if you come to think about the investments, it is quite important how investments show up in the budget of the government. So you were telling about budget constraints, but it's also the way of how it is accounted for. Is it accounted for as spending? And to me, if you are talking about resilience measures, I would say it is a measure of investment. So accounting for that in budget as spending is not really helpful, first of all. It is, of course, limiting the ability to do the investment. And it's also not reflective of what you are doing. And not only economically, but I also want to stress socially. Because investments you do today, they are not for the generation now, they are for generations in the future. So it also makes sense that the burden is carried over generations. So that's my...
So reducing exposure is not only about spending more, but how resilience is planned and embedded in public frameworks. It's not a thing that really depends on the amount of money that you invest, but if you invest in the right way. So, John, coming back to you again, what does it take to integrate these two so that resilience investment are viable, visible in fiscal frameworks and risk reduction, not just expenditure? And what is the shift in how governments plan and budget that would most reduce fiscal exposure to water shocks?
It's a challenging question. And I'd step back maybe a little bit, and I'd say that one of part of the ethos, I think, of this meeting is the idea that we need to have fiscal stability. And I'd say that we're actually really challenged in that process when we have climate instability. And that there's a really deep tension there. Again, referencing Kate's talk this morning, water comes from climate. It doesn't come from necessarily landscapes, or certainly not from pipes. So we need to think about what happens when the climate is actively changing, is going to continue probably for many decades or centuries at this stage. So there's a tension, in effect, that exists between how we manage, how we conceive of resilience planning versus how we think about fiscal planning. And I'd say that the measures that we use for those two things, that they are to some degree in conflict. Resilience planning, you're looking at how assets, how flows, how stocks are going to change over time and evolve, and what you need to do to be able to compensate and adjust for them. And then for fiscal planning, what we have been using primarily is the concept of efficiency. It's a very old economic concept. It's a part of the deep ideas within going back to Adam Smith, and resilience and efficiency are not the same, and they are in tension with one another. I would argue a highly efficient system is probably not one that's going to be resilient. It probably is brittle, and a resilient system is not going to look that efficient because you're paying for extra things. You're building in redundancy. You're building in some flexibility. You're adding to the robustness of the system. And so I would argue that in effect, what we need to do is find some kind of reconciliation for that. We need to add some resilience to our concept of efficiency. And part of that is that we also need to be able to really measure what resilience looks like. Resilience, at least in my world, is one of the most overused and underdefined words. We have often kind of it's a word that we often politely sort of ignore any depth to it. It's but Andy Roby earlier today, he was talking about the Global Goal and Adaptation, the GGA. This is part of an effort within the UNFCCC framework to actually come up with specific measurable indicators for resilience that say if you're moving towards it or away from it. If you're to be able to inform decisions that increase resilience, or if a decision or action is not resilient, and that's a huge change. The MDBs have a working group actually on this topic. It started about a year and a half ago and has continued to build work. Agua in partnership with Deltares and ARUP and EMI has been working very actively to try to develop indicators in that space. So there is a lot that's happening, but I don't think it's kind of made that transition into thinking at the level of economic planning in general, much less kind of more specific fiscal planning efforts. Juan Carlos also mentioned in his comments just in the beginning here that there were kind of two central major points that he thought were big advances in the area of climate change, and one of them was stress tests. I completely agree with that point. Is a fantastic point. And I think that these stress tests are probably where we can see efficiency and resilience begin to work together. We can explore ideas in a stress test about when we need to be efficient and when we need to be resilient. And we can use it as kind of a hypothesis testing mechanism, especially if we kind of open it up from just the direct physical risks and we start to think about some of those allocation and governance issues and maybe some of the larger political economy in that space. And like a simple example of this, we have a program that it's called the Water a Resilience Tracker, and it's really a kind of policy and governance engagement around the concept of resilience. We work in around 15 countries so far globally. We'll probably add a couple more this year. It's been around for 5 years so far. We mostly work at the national level, but some countries we work at lower levels. One of the countries that we view as our most important partners on the tracker is Brazil. We've been working there for about 3 years. And the tracker, it almost uses a kind of Socratic methodology in terms of being able to kind of ask provocative questions across ministries. We've worked with around 11 ministries so far in Brazil. And that process in such a big, complex country has really revealed some interesting patterns. For instance, when we went to one of the agriculture ministries in their 5-year, in DC, their 5-year climate commitment under the UNFCCC, they said, we want to triple the amount of irrigation in Brazil within a 5-year period. This is a very irrigated country. They already irrigate a lot, but to raise it by that level over such a short period of time is impressive. And, we were surprised by that, and we said, that's great, where's the water coming from? And they literally said, that's not our problem. So just over a year ago, we had a workshop on the results from that kind of initial assessment in Brazil, and we kind of presented some of these kinds of gaps. The first person to stand up, of the 11 ministries in the room, first person to stand up was from the agriculture ministry, and he said, it is a fundamental error of our ministry that we did not prioritize water and how we thought about resilience. And I regret what we said and did, and we will change that. And that is a powerful epiphany, right? It is a deep change that's happening, and I would argue that it is that shift from efficiency to resilience that's occurring in that space. So maybe just as a final quick point, I think that there's also the focus on risk is so important. It's how we see the dangers that might be coming ahead, but we also, I think, through the planning process, it should be how we also see the opportunities that may be coming up. And that's a big thing. We need to be thinking about the positive things that we might be able to take part in and to become connected to. That there is a risk of actually losing those opportunities if we're not looking for them and trying to find them. Thank you.
Thank you. Well, resilience is a word that we are listening all the time here in this session, but resilience needs investment and financing, of course. So, Tim, from your perspective as a public financial institution, how does this play out in practice? Under what conditions does the investment case actually work? And when it does not, which are the main barriers to it? And briefly, what does this imply in the way public development banks assess and manage their own exposure to water-related risks?
Okay, well, I think
long question.
Just for the first question, when are investments successful, if I may deem it like that, define successful, but okay. That having said, I think what is key is that ownership and requirement is clear. If it is clear who is responsible and what is the requirement they have to adhere to, then the financing system works. In our case, okay, we are able to attract funding at attractive levels in the market due to our AAA rating, due to our profit nature, we can give it at attractive rates, and that works. If ownership and requirement is not clear, then it becomes a bit difficult. And what I mean, if requirement is not clear, then there's uncertainty about cash flows, and I think it was also mentioned earlier in discussions, you have some capacity building. What are the cash flows and who's entitled to the cash flows? So if you look at, for instance, water efficient building, it would be in the interest of several parties, but one party is bearing the cost for it, and that's problematic. And I think that leads me to what was mentioned before. We have to think about systematic. So we have to bring together all parties, and it's also related, I think, to the question, to the statements before, that the price of water is not the same as the value of water. And in my opinion, the case which was mentioned by Microsoft is illustrative for that. If you see the one who is responsible for the leakage of the system, well, he does the math. He says, okay, I have to repair it, cost X, and the price I get for my water is very low. So it's not economically. Well, on the other hand, Microsoft says, okay, for me, water is very important to run my business, and from that, I'm willing to pay for the repair system. So I think bringing together all stakeholders is very useful and helpful, and it bridges the gap between price and value, and also about the distribution of the benefits, I would say. And well, without, this was mentioned before, that data is a lot of uncertainty. Also, the tipping point is very difficult to see, but given an eye on 5 o'clock, I leave it here with my comments.
Yeah, so really when resilience investment is timely, credible, and well-designed, it can really reduce the exposure to water risks rather than just shifting costs or potentially affecting credit quality. So run from what Moody's Ratings is observing across sovereign and sub-sovereigns, what role does the timing and credibility of resilience investment play in whether water stress remains manageable or becomes a source of sustained fiscal and credit pressure?
Great question. So I think timing ultimately means that whether a risk is absorbed manageably by CapEx, or it becomes an operating issue, or it becomes an emergency spending, which is, means more CapEx or more OpEx. So I think timings are very important, but also within the credit analysis, it's for us less about hydrology, but it's more about the cushion around any kind of risk. So the three things which is kind of important to credit analysis is the water governance. So we've heard water governance many times today, but what does it really mean? It's about allocation framework. It's really about, ultimately, at a very high level, given the limited supply of water, how is a sovereign managing that? How is a sub-sovereign managing that? We saw the Dana floods with Spain, but although the exposure of issuer profile scores within what we score in Moody's, they increased, but the credit risk didn't increase just because they had the financial flexibility, the fiscal capacity to weather the weather.
To cope.
Forgive my pun. So it's really about water governance. Secondly, it's about infrastructure adequacy. So storage levels. Look at the desalination plants within the Gulf right now. Looking at amount of storage levels they have is an important part. But also it's about how is the infrastructure working. I think an important point we look at is redundancy. So that means, what about the leakages? So I think we've heard earlier today about Costa Rica, I think about 60% leakages. That's normal for a lot of the countries, is high double digits. So we're talking about what new things can we do, but the biggest problem is currently what is happening now and how are government letting it happen. So infrastructure adequacy is very important to us. And then thirdly, financial flexibility, which is the core of credit analysis. And this is where different countries with a similar kind of water stress have different exposure or credit exposure to the risk. So by financial flexibility is, again, able to put money where the mouth is and essentially absorb that risk. But also, being able to fund certain infrastructure, adaptation infrastructure, resilient infrastructure early. And just putting on some numbers there, World Bank estimated that's a shortfall in spending of 31 to 47 billion for low to middle-income economies just to access safe water. And also, another interesting fact over here is figures show that water sector only executes 72% of allocated budget. So there's a lot of new things we could do, but what about the current things that can happen right now? But also, there are positive stories or good cases that we've seen across sovereigns. We see Singapore, which is one of the most water-stressed countries in the world. Their four-tap policy governance, being able to recycle water and so on and so forth. They're AAA country doing very well looking at the exposure. Then again, all of GCC Gulf nations, again, some of the most water-stressed countries being able to manage the water stream. So there are examples out there. That's not magic one that we need. There's examples out there that we could look at looking at the exposure. And then finally, just very quickly, look, capital markets are starting to respond. Within Moody's, we have a sister company looking at second-party opinions, sustainable bond markets. So a lot of sustainable bond markets linked their use of proceeds to water projects is increasing. There are increasing KPIs looking at different system which could impact how the bond assessments are rated to improving water quality, improving water projects. So we are seeing the shift of water investment going from cost to a strategic investment adaptation and resilience. So I'll leave it there.
Yeah, thank you. I mean, you could say really that outcomes are driven not just by investment, but by how well risks are identified, measured, and priced. So according to your experience, Helen, what does the analytical frontier on nature and water-related sovereign risks actually need, in your opinion? And what is the methodological gap that, if closed, would most change how finance ministries, rating agencies, and development finance institutions engage with these risks?
Thank you for that question. And speaking of analytical gap, methodological gaps, and frontiers, I think that I see three main dimensions. The first one is about improving quality of data about the actual condition of water-related ecosystem services, because it's not always available and known about whether it is in a good shape or not. So that knowing about that would maybe moderate our evaluation of the risk, because if a country is exposed to water-related ecosystem services, it's better if this one is in a good shape than if it's not. So knowing about the condition of these ecosystem services would help a lot for assessing the actual risk. The second dimension is about one that you spoke earlier, about opportunities. There are not much modelization yet that was made about the economic benefits of investing in water preservation and adaptation. So I know that there are some ongoing research going on how to modelize macroeconomic gains of this investment, and maybe that could as well liberate some fiscal space in the future, and that could be measured. And lastly, a lot of strategy for a lot of countries have made some list of what are the investments that are needed, namely in national adaptation plans, in NDC. The lists and investment needed are available, but we know less about how much governments are already spending on and investing on these. And some countries are trying to look within their budget at every budget lines whether it is or not contributing to adaptation. So France, for instance, is doing that, and I think Spain is also doing that, trying to do budget tagging and actually reveals to the public and to the other authorities about how much is already being spent to tackle these risks. So, and I think that would help to have this clarity and to know what is already in place to mitigate the risks.
Okay, so now let me ask you, Esther, from your perspective, which are these key gaps that still need to be addressed to better integrate water-related risk into fiscal frameworks? And in particular, if it would be great if you could share some concrete examples from Spain that illustrate these challenges.
Thank you, Noelia, for your question. Well, within that, building fiscal resilience to water shocks and to climate, more in general, climate-related shocks requires perhaps a simple but very, very demanding approach. First, we need to measure the risk properly, and this is the most important gap that we need to face. Second, as many of you have mentioned, reducing exposure and vulnerability. And third, when extreme events occur, we need to design instruments that allow us to smooth or to share the impact on the budget. Regarding measuring, well, of course, I was, in my previous intervention, I was mentioning that we are improving the data that we have to analyze the past, how has been the past fiscal cost of these events for the Spanish economy, but we need to predict for the future in order to prepare and to ensure that public finances are prepared to accommodate the impact. We need to predict how likely is going to be and how severe are going to be these events. There are some methods in the literature. Of course, at IREF, we have tried, on the basis of the past costs, we are trying to predict what could be the probability of having an extreme event. We have estimated a fiscal loss curve that allows us to link the size of a possible fiscal loss to the probability of this event occurring, and we find that there are significant costs. For example, we find our estimates show that the fiscal cost could be around 10 billion euros for an event, for a 1 in 50-year event. So this is perhaps not very much for big countries, but for us, 10 billion is close the amount that we spent in housing policies in 1 year. So very significant effects. And of course, these estimates are based on past data, and we know that these events are increasing in frequency, increasing in severity. Ting was mentioning there are non-linear effects, tipping points. Extreme events are not just only the large version of small events, so we need to improve very much the analysis that, and on top of that, we are finding that some events tend to compound, they tend to interact, droughts with wildfires, so we need to improve very much the analysis in order to know what is exactly the magnitude of the challenge we are facing. And that's the main point we need and the main gap we need to improve in order to build fiscal resilience. Regarding reducing vulnerability, I think that Helen and team have mentioned that we need to improve the design of our budgets. There is an approach that is that is being really encouraged by the European Commission and also the OECD, which is called green budgeting, and I think that's the way. It increases a lot the transparency that on the efforts that the different countries are making in order to face these challenges. So I think that's the way. Of course, it's still at a very early stage, but that's the way. And just finally, a final comment to smooth the impact of these events, these extreme events when they occur. you were asking me examples. I think that in Spain we have
few.
a very good example of a very good instrument that allows public budgets, which is, of course, the Insurance Compensation Consortium, the Consorcio de Compensación de Seguros. It's a very good instrument that allows us to smooth the impact of these events, not only across time, because they will reserve when there are no significant damages in order to face the more extreme events, but also to smooth the impact between the public and the private sector, because they are financed through surcharges in insurance premiums. So I think it's a very, very good instrument to follow, but we have other examples in some countries. For example, we were reading the other day about the Caribbean Catastrophe Risk Insurance Facility, which has very good properties in the sense that it's a multi-country, multi-risk facility, but the trigger, they follow a kind of parametric trigger in order to assist countries affected by events. They don't look at the intensity of the damages. They look at the intensity of the event, which allows them to deploy a more rapid response. And we have a lot of evidence showing that the speed of the response tends to be highly correlated with the final damage. So, and in Europe, just a final comment, we have the European Union Solidarity Fund. We know it's not a perfect fund. It has a very partial. Its size is limited. It covers only part of the cost, but well, it's a good instrument. It's financed by the European budget, so it's a good. Perhaps in the future it could grow more, and it's a good instrument to smooth the impact in any particular country.
Yes, in fact, tomorrow we will be having this session on insurance, so I think that we will have a big opportunity to talk more deeply into the role of the insurance as a cushion against these water risks. So I'm sorry to say that we are running out of time. I'm afraid we will not have any space for questions from the audience, so I apologize for that. But I would like to conclude very briefly with the main takeaways that we have heard today in this session. So very briefly, I will just say that it's obvious that the fiscal relevance of water-related risks. These risks are real, are material, and are increasingly visible in financial markets. In fact, sovereign credit assessments are already incorporating these risks, water risks, in financial markets and rating agencies, and it's also recognized as a key transmission channel for physical climate risks. At the same time, the impact of these risks varies significantly across countries, depending not only on exposure, but also on governance and water management. From this session, I think that we have identified that for building fiscal resilience, we require two things: prevention and integrating water risks in fiscal planning. As regards prevention, we are thinking on investment in conservation and adaptation, and to be effective, it's essential that they are timely, that they are designed in a credible way, that they put a clear allocation of responsibilities, and that it aligns incentives of different stakeholders. But there are also operational requirements that need to be addressed to overcome water risk assessment and fiscal planning, from better information and measurement of water-related risks to stronger analytical tools to have a more robust assessments of water risk to capture, for example, non-linearities or tipping points. So taken together, I think that all these elements are essential to move from reacting to shocks to systematically building fiscal resilience in a water insecure world. So let me stop here. I would like to thank our panelists for all your insights and your great discussion. Ram, Helen, Esther, John, Martin. And thank you, everybody, for your attention and engagement. And congratulations, you made it through this day. Okay, so we hope to see you tomorrow. And, well, thank you so much. Enjoy the rest of the evening.